Hi everyone, welcome back. Today we're going over what is a mutual fund, as the title says, and we're going to do it in less than 10 minutes. So we're going to go over a high-level review of what is a mutual fund, why you might want to buy one, and how it works. All right, so let's get started. The best way to explain what a mutual fund is it's kind of like if you go into a grocery store and you buy a salad. And that salad has things like lettuce, it has, sauce or salad dressing. So it has dressing, it has maybe peppers, cucumbers, etc., etc. So you could either buy the whole salad that has all of that already included, or you can buy each thing individually. So you can buy the lettuce, you can buy the peppers, you can buy the cucumbers, etc. So how a mutual fund works is it's a similar idea where if you buy one fund, you end up actually buying dozens, if not hundreds, of stocks. So you can buy one fund, and then that means that you own a little bit of Apple, you own a little bit of maybe Amazon, Tesla, Microsoft, etc. So what you could do is that you could go out and buy one share of this, one share of this, one share of this, one share of this, etc. However, that's going to end up costing you quite a bit, right? So if each of these are a few $100s, just by buying one share of each of them, you're going to be spending thousands of dollars. So what you can do instead is that you can buy a unit. So that's how mutual funds are bought and sold. They're bought and sold in units. And by buying one unit, you end up owning a bunch of stocks all at once. So you can find mutual funds that are based off of the S&P 500. So what that means is it's the 500 largest companies in America. So if you name names like all of the ones that we have listed here and a lot of other really big company names, they'll be included in the S&P 500, which is a US-based index. You also have Canadian ones like the TSX, okay, and the TSX 60. So top 60 Canadian stocks. You can do foreign ones. So you have ones like the Hang Seng, which is from Hong Kong. Okay, you have Paris. You have what else do we have? The UK, etc. So you can also buy foreign ones. Okay, so you can buy a unit or multiple units. And a great benefit of mutual funds is, let's say a unit costs you $53, okay? And you only have $153. You can buy partial units. So that's another benefit. So you can own partial units of mutual funds. So when you go to place your trade, you can say, I want to buy $150 worth of it, because you can have partial units of mutual funds. So that's actually a really great benefit, especially when it comes to newer investors or maybe someone who doesn't have as much money. Other benefits include that a lot of times, and you do need to double check this with your brokerage, but a lot of times there are no commission fees, okay? And when we say commission fee, what that means is it's a direct fee to buy that product. So a lot of times stocks will have it, and usually it's about $10 per transaction. So buying it will cost you $10. Buying more will also cost you $10. Selling some will cost you $10, etc. So it will eat into your profits. So if you are an individual who does dollar cost averaging, and what that means is taking, let's say, $100 or a specific dollar amount, and every 2 weeks or every month or whatever time frame works for you, you buy more of that same fund. So if that's something that you would like to do, that $10 is going to eat into your profits very quickly. So what I'm trying to get at is with mutual funds, a lot of times you will not have to pay that $10 fee. You will need to double check with your brokerage. Now, with that mutual fund, it is looked after by a money manager, okay? So they do all the accounting, they buy and sell stocks within that fund itself so that you can get hopefully the best return possible. So you can get mutual funds that are more active, where the fund manager actively buys and sells, or you can buy ones that are passive, so the manager doesn't spend as much time and effort buying and selling. Now, regardless of which one you choose, there is an MER fee included within the fund itself. MER, let me rewrite that. MER, there we are. And this is called a management expense ratio. Now, this fund can vary quite a bit. So it is dependent on, this fee can vary quite a bit. So it is dependent on the fund itself. So you will need to do research on this. It can range from, the lowest is maybe about 0.05, maybe 0.09 or so. And then you can get ones that are a lot more expensive, maybe about 2.5%, okay? So that's the price that you're paying because there is an individual managing this fund. So you really want to double check with the value of the fund. You want to pay less rather than more. So like I mentioned before, there is usually there is a manager who decides what to buy and sell within those accounts. So you need to determine a mutual fund that has lower fees because these fees will eat into your profits. Now, how it works is this fee isn't something that's charged monthly. It's not charged annually. How it works is, let's say that the value of the funds increased by 1%. And to note as well, the funds, their price is not like a stock or an ETF. It does not change during the day between 9:30 to 4 p.m. It resets overnight. So depending on your brokerage, maybe 9 o'clock, 10 p.m., 11 p.m., etc. The fund only updates once, and that's in the evening, okay? So let's say if the value of the fund went up by 1%, and you're paying a 1% MER fee, you might see that the value of your mutual fund that you owned, instead of it going up 1%, which is the combined amount of all of the stocks that you own over here, you'll see it goes up by maybe about 0.99% or so. So this 1% fee is baked into it already. So it's an indirect fee, not so much a direct fee. But obviously, you do want to make sure that you are paying less rather than more. Now, with mutual funds, like I mentioned, the value of it only gets updated once per day in the evening. And the reason why is it's a number of different reasons, but if you think of a stock goes between person A to person B. With a mutual fund, when you buy and sell them, or when you buy and redeem them, it goes to and from the actual mutual fund company. That's who you're buying it from and selling it to. So that's one of the reasons why the value of it updates overnight. Now you can buy lots of different types of mutual funds. So you can buy ones, like I mentioned, based off of an index like the S&P 500, the TSX 60, etc. You can also buy ones, now we're starting to get tight for space. You can also buy ones based off of things like utilities, okay? Finance or financial companies. Maybe things based off of technology. You can buy ones based off of emerging markets. So there are quite a number of different kinds of mutual funds that you can buy. So you could find very large, big ones, okay, like the S&P 500, or more specific ones. So altogether, this is a high-level look at what is a mutual fund, just so you can understand how it works and some of the benefits and risks that come with it. Of course, there is risk to buying and selling anything, be it mutual funds, stocks, bonds, etc. But here you're at least able to see what does it mean, okay? How does it work? And a little bit in regards to buying it and the fee associated with it. So I hope you learned something new today, and I hope to see you in a future video as well. Bye everyone.